The market is open and we see green right across the S&P, although we are starting to see some weakness in the energy sector. Today we are focusing though on Intel, which is reporting after the market close on Thursday, and as we saw in their previous earnings, it was in fact absolutely horrific. Now, a few key things we just want to highlight before we talk about them moving forwards. They talked about cutting their workforce by around 15%, worse than expected quarterly results. They issued guidance which was lower than what they had previously stated, and in fact, one of the worst things for dividend investors, they had eliminated the dividend completely. Now, when we take a look just for a refresher of how bad those earnings were, well, they reported 2 cents, a massive miss to the 10 cents the market was expecting, and the revenue did come in slightly lower, 12.83 versus 12.94. And we also note their revenue is down around 1% from the same quarter in 2023. So overall, it didn't look too good. Hopefully though, with the reporting coming soon, we can see something that shareholders will look happier about. And when we look at the company itself, it's down around 30% over the last 12 months. Year to date, down in fact more than 50%. So it has suffered massively. And when you zoom out over the last 10 years, it's down around 32%. So do we have a great opportunity now to buy this company towards its 52-week low before the earnings? Are we expecting some very positive news? We're going to take a look in today's episode, also run through our own valuation. We noticed, quite rare on this channel actually, Seeking Alpha, Wall Street and Quant give this company a hold. It has a forward P of 88, something we will come on to shortly. And we also want to highlight in today's episode some news that this company has recently faced. Now, the first one, good news for investors. Their new Intel Core Ultra has already sold out and is expecting to be restocked very soon. In fact, this has been sold out in both Japan as well as US. So good news in terms of hopefully that will boost some of their top line revenue. We also noticed not too long ago, middle of September in fact, they did have a partnership with Amazon, and quite a significant one as well. Amazon effectively asking them to produce at least 2 custom chips, which again, like we said, a lot of this will help bolster their top line revenue as well as the bottom line net income and EPS that has suffered in the shorter term. Now, we did also come across this interesting article talking about how, in fact, Intel could be broken up, and there were lots and lots of rumors, in fact, about different semiconductors coming in to buy parts of this company. We had rumors circulating around Qualcomm. However, these ones so far haven't come into fruition yet. Something, though, just to consider. In terms of the actual earnings though, we can see a lot of inconsistency over the next few quarters, negative growth pretty much anticipated, and over the previous 4, well, we just mentioned Q2 where they had an 8-cent miss. Previous to that, they did beat, so 75% track record, 3 out of 4, and we do anticipate over the next full year EPS around $1.12, which will lower the forward P to a much more reasonable number at 20.23. Now, in terms of the company itself, as we said, they have in fact now cut or eliminated, we should say, the dividend for the foreseeable future. Over the last 5 years, if you've been holding this company, the dividend has decreased 9% year on year. Over the last 20 years, increasing around 12%. But as we can see, right now that dividend has gone. Whether or not it will come back, again, something we can discuss at a later date. Now, no real point talking about the free cash flow payout given the dividend is 0, and that is reflected in the next 12 months, this payout at that nil point. In terms of free cash flow per share, not looking too good. Typically, we want to see increasing over the longer term. What we notice, pretty much flat from 2014 to 2021. Since then, the last 2 years and on a trailing 12-month basis and over the next 12 months expected to be negative. So something just to consider moving forwards with this company. Then we get to their sales growth, which unfortunately isn't any better in the shorter term. Last 2 years have been very, very poor, down double digits both years. And prior to that, we do get a lot of inconsistency. Some years looking good, 13% in 2018. Other years we can see very low, 1-2%. And when you do zoom out in terms of a numerical standpoint, their top line is pretty much the same in 2023 than what we saw in 2014. Yes, it has increased and then decreased, but when you zoom out, again, not something we really want to see. Maybe we're starting to uncover why, in fact, we do get that triple hold rating. We then move on to the shares outstanding, where as always we want to see companies return excess cash to shareholders through those share buybacks, something we have seen with Intel, but do note that from 2021 they've done the opposite and they have started to dilute shareholders, and it could be something they do, especially with performances getting poorer and poorer. Something we just want to flag though, bear that in mind in the more recent term, they've actually been diluting your position. ROIC 10% or more, give us faith management are able to effectively allocate their capital, looking very good up to 2021. Last 2 years very poor, 0% on a trailing 12-month basis, as well as the full year of 2023. Now, operating margin, we would actually say if it cut off at 2021, this looks very good, above the minimum 16%. But what this ultimately means, when the operating margin is lower, as we will come to see, they wouldn't have been able to turn a profit. As we can see, that sitting there at 0% isn't good news. 1% as well on a trailing 12-month. Again, not looking too good in this shorter term. Free cash flow margin, again, up to 2021, looking very favorable. Last 2 years, sitting in the negative double digit. Now, net debt to EBITDA, earnings before interest, tax, depreciation, amortization. For semiconductors, well, we want to see a maximum of 1.5. What we get here, in fact, above that in 2023, it's actually been increasing. What we want to see here is the opposite, decreasing, and over the next 12 months, expected to be around the same. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. So again, something to consider. We will look at their balance sheet, but ultimately we need to add a large margin of safety if we are to consider this in today's episode. Now, we also want to flag we've just released our latest free weekly article. We drop one to your inbox every Monday morning where we talk about some undervalued stocks that we do believe deserve your attention, as well as what's going on in the market over the last few days. So do click on the pinned comment below, sign up, and you can read straight away. You'll also be able to gain access to undervalued stocks that we do believe deserve your attention for this month. We also highlight the upside Wall Street see over the next year and flag those that sit within our own portfolio if you're interested, as well as being able to grab now for this month 22 undervalued stocks that Wall Street themselves believe have the most upside in the S&P over the next year. So as we said, click on the pinned comment below, sign up, and you can read straight away. We then move on to insider ownership, which sits at 0.04%. We see no selling over the last year, in fact, and over the last 12 months, the same period, we see around 1 million worth of buys. Now, in the more recent quarter, there's actually no movement. You have to go to Q3 where we see the buying, and you could argue a little bit outdated, but again, we will just flag here that the CEO on the 5th of August did buy around 12,500 shares for around $250,000. Now, we do typically say on this channel it is very bullish if insiders are buying. They buy because ultimately they believe the share price will go up. Do bear in mind though, with the CEO, he has also bought many shares over the last year at some very high prices in relation to the current value, so just something to flag. We then look at institutions, around 65% ownership, around 7 billion worth of sales over the last year. But we notice nearly double the amount of buys during the same time period. But we do want to highlight that in Q3, we actually see a little bit more selling than buying. However, the previous 3, we see more buying than selling. So overall, institutions do like Intel. They are buying more. We've just noted though in Q3, the more recent data point, they have been selling. As always though, do your own due diligence. Never copy what these insiders do. Now, revenue we've already flagged, very poor. In fact, very minimal movement over the last 10 years on a year-on-year basis as well. Very inconsistent. When we look at the bottom line net income, not something we want to see. Again, inconsistency and in fact decreasing from the highs of 2018. As we see in 2023, 1.7 billion on a trailing 12-month, even lower at 975 million. So it is moving in the right direction. In fact, we see a very good period for this company, 2018 to 2021, with high double-digit net income. Unfortunately, it has been decreasing ever since. Then we take a look at their balance sheet, which, as we said, has been moving the wrong way. We want to see the net debt to EBITDA decrease. Well, cash position itself has pretty much increased from 2014's position of 14 billion to 30, in fact, pretty much doubling. However, in isolation, we don't look at any of these numbers, which is why we then take a look at their total debt numerically and directionally, which is what we want to see for every other metric but the total debt. This has been increasing from around 14 billion in 2014 to 53 billion. Definitely a red flag indicator in our opinion. Then we move to the gradings. First one, valuation with a D. Now, no surprises, we see the forward PE sitting much higher than the sector, so you are paying a 266% premium for this company right now, but if they do hit the target for December 2025, it will come down substantially. So it depends which valuation metric you use. Actually, some of them, they don't look too bad, a little bit of a discount, but if you solely look at the forward PE, right now, based on this data, it is trading at a premium. We then get to the growth, which looks very poor in F grade. Year on year, top line 2%, sector median marginally better 3.45. Revenue forward looking decreasing -4 versus the sector at 6%. And the one thing that we always like to draw your attention to, EPS over the next 3 to 5 years, 8.5%, whereas the sector overall sitting at 15%. So not looking too great in the valuation or the growth department. However, when we get to profitability, it does look a little better. It gets an A+, although we notice the gross margin 41%, sector at 50% doing better. Bottom line very poor at 2%. Again, sector, although better marginally at 3.7. One thing though that we do quite like is their cash from operations very high, giving it the overall A+ rating as well, 11.5 billion versus the sector's 93 million. Now, quick recap, we see the triple hold from every single analyst, a D on valuation, an F on growth with an A+ on profitability. So in terms of how they've performed, is this an issue with Intel or the sector? Well, we have other comparable companies, Analog Devices, Micron Technology, I'm sure you've heard of many of these. And over the last year, no surprises, Intel is the worst performing. Actually, every other company has done very strongly over the last 12 months. Over the last 5 years, we see pretty much a very similar story, -53%, every other company doing significantly better. Over the last 10 years, again, that same story is to be told. So can they perform a lot better over the next 5, 10, 20 years, whatever your time horizon is? Something to consider, but we also want to flag over the last year, over the last 5 years, and over the last 10 years, it has massively underperformed the S&P. In fact, S&P over the last 10 years is up 188%. Intel down -13. So if you had invested, for example, $10,000, you would actually have a lower amount sitting right now, even including those dividends reinvested over the last 10 years. So not great at all. But as always, let's jump into our valuation. And if you are enjoying the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our valuation for Intel today coming to $28. Running through the DCF model, and as we will show you here, we have the free cash flow year on year. We have a growth rate moving forwards of 0%. With that, with the discount rate as well, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, our 2820 effectively giving it 23% upside. Now these numbers are subjective and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Intel or any others. But for full transparency, for those that believe it should be 4%, we get intrinsic value of $38, indicating 64%. And for those that believe it should be 8%, well, we can see $50, 118% upside, meaning more than double the current trading price. As we said, we are going to take the 0% across, and what we always like to do is have a margin of safety where we use 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $25, then we keep going till it's near the current trading price. Not at 20% just yet, but Intel we see sitting around 15 to 20%. Now, Wall Street themselves have upside of 13%. Their price target is $26. But as always, we'd like to hear your thoughts below. Do you agree with the analyst? Is this a hold? Maybe it's one you've been buying as it did go to its 52-week low. Or for whatever reason, you did sell it, maybe straight after the dividend cut or just after that. As always, give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and joining us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.